If you want to pursue a career as a broker, or if you just want to learn how to follow stocks for your own personal benefit, the first thing you should study is the stock quote numbers. You can find stock quotes in the business section of major newspapers, in business publications like the Wall Street Journal, or on internet financial sites. If you've ever looked at these financial pages, you've probably noticed a lot of fine print. What do all these tiny numbers and symbols mean? Let's take a look. Each line reports the status of a company's stock on the close of the previous business day. Corporations are listed by a standard abbreviation. Let's say our fictitious company, Super Stereo, is listed as SST. We look through the stock tables until we find SST. Then we read across that line of financial information. Here is a sample listing for Super Stereo. Let's go through these figures one by one. 52-week high means the highest price per share in the past 52 weeks, which is 1 year. For Super Stereo, that number is 39.44, or $39.44. 52-week low is the lowest price per share in the past 52 weeks. Super Stereo's 52-week low is 18.38. The next three columns show how profitable the stock has been. DIV represents the dividends paid, in this case 40 cents. The yield is 1.2. That means the 40-cent dividend is 1.2% of the current stock price. The third column is labeled PE. This stands for price to earnings ratio. The PE ratio is the stock price divided by the per share earnings for the last 4 quarters. Because share prices fluctuate even within the trading day, the day's highs and lows are listed as well. The high, or highest price for the day, is 32.63. The low, or lowest price for the day, is 30.69. Close means just what it says, the price of a share at the end of a trading day. Super Stereo closed at 32.31. Finally, change, or net change, means how much a share of stock changed in price from the previous day's closing price. Super Stereo's change is plus 0.44. That means the price of a share went up 44 cents from the closing price of the day before. Stock analysts plot these numbers on a graph from day to day. Over time, the graph forms a picture of how a stock performs. This helps investors and analysts determine whether or not corporations are good investments. Analysts track whole groups of companies this way. However, tracking stock performance is not the only factor analysts consider when making investment decisions. A company may have control over its productivity, but it can't control outside factors. Therefore, analysts must keep an eye on industry and economic trends as well. Let me explain. The economic world is broken up into industries. The retail industry includes all the businesses that sell manufactured goods directly to the consumer. The manufacturing industry produces those goods. The agricultural and mining industries provide food products and raw materials to retailers and manufacturers. Now, how would each of these industries be affected if, say, the price of oil increased significantly? Many industries rely on oil to produce goods, harvest raw materials, and even transport finished products to retailers. When costs go up, they eat into profits, causing earnings to decrease. The stock price of some companies will be affected.